Hello, welcome to the weekly technical analysis review here at xm.com. I'm Rafi currency analyst, and today is Tuesday, June the 27th, 2017. Today we will look at the dollar yen, the pound dollar, the euro yen, the Kiwi dollar, and gold. So let's get started with dollar yen. USDJPY has increased its bearish bias in the near term following sharp gains yesterday. The RSI is comfortably in positive territory at 57, and the MACD has also just turned positive. Prices briefly broke above the 112 level earlier today before pulling back. The 112 handle is just above the 38.2% Fibonacci retracement level of the April to May up leg from 108.12 to 114.36, and this is proving to be a strong resistance area. If prices manage to clear this area, the next target will be the 23.6% Fibonacci level at 112.90, while further up the previous resistance area of 113.70 would come into sight. Failure to break above 112 would likely see the pair losing its current positive momentum, with the nearest support coming at around the 50% Fibonacci retracement at 111.25. This is also where the 50 and 200-day moving averages are currently converging, making this a critical support region. A break below this area would turn the near-term bias back to neutral and open the way towards the 61.8 and 78.6% Fibonacci levels at 110.50 and 109.45 respectively. Looking at the medium-term outlook, the pair remains neutral. Next, let's look at the pound dollar. GBPUSD remains stuck in a neutral bias as it drifts further inside the Ichimoku cloud. The RSI is just below the 50 neutral level, suggesting that today's upside momentum isn't strong enough to take the indicator into positive territory just yet. Immediate resistance on the upside comes from the 1.2775 level, which is just above today's intraday high. The Kijun Sen line could act as a further barrier at the 1.28 handle, but a bigger test would be the top of the cloud at around 1.2855. This is also where the 50-day moving average is converging, so a break above this level is needed if the pair was to turn bullish again. To the downside, the Tenkan Sen line at the 1.27 handle is the nearest support. Further down, the 100-day moving average could act as further support at 1.2630, while further down we have the 200-day moving average at 1.2535. In the medium term, the recent declines have weakened the newly formed bullish picture. As a result, the outlook is in danger of reverting back to neutral. Our next pair is Euro Yen. EURJPY hit a fresh one-year high of 126.15 today, successfully breaking above the strong resistance mark of 125.80. The near-term bias is looking increasingly bullish, with the RSI fast approaching overbought levels. The medium-term outlook has also turned more bullish, with both the 50 and 200-day moving averages trending upwards. Further gains should see the 127 handle coming into focus as the next key resistance point. Should the gains fail to sustain, however, a downside reversal would see the recent congested area of 124.85 acting as support, with the 200-day moving average providing an additional barrier below at around the 124 level. Further down, we have the 50-day moving average at 123.32. Moving to the Kiwi dollar pair, NZDUSD rose to a fresh 4.5 months high of 0.7343 earlier today, as the pair extends its 1.5 months long uptrend. Near-term indicators are very bullish as prices climb further above the Ichimoku cloud, and the Tenkan Sen and Kijun Sen lines are both ascending and positively aligned. The RSI is also bullish and has yet to cross into overbought territory, suggesting the current rally has more room to run. Further gains would likely see the pair meeting resistance at the February high of 0.7375, followed by the November 2016 peak of just above 0.74. To the downside, the Tenkan Sen line is the nearest support at 0.7264, while further down the 0.7210 level, which has previously acted as support, is the next support level to watch. Below that, the Kijun Sen line is another potential obstacle at 0.7165. The recent gains have done little, however, to alter the longer-term outlook, which remains neutral for Kiwi dollar. Finally, let's look at gold. Gold has turned slightly bearish in the short term as it continues to retreat from June's 6-month high of 1,295.97. The MACD histogram has fallen below zero, though not too far, and is below the red signal line. Should prices continue to drift lower, the 200-day moving average is the nearest support at 1,236. The 200-day moving average also acted as support yesterday when prices fell sharply before rebounding. Further losses would see support coming at around 1,232 level, which is the 78.6% Fibonacci retracement of the May to June upper leg from 1,214.17 to 1,295.97. To the upside, a major resistance area has been formed at the 50% Fibonacci retracement level at around 1,255, and this is also where the 50-day moving average is currently flatlining. Prices have struggled to rise past this area in the past 3 days. A successful break above this level would shift the bias back to positive and open the way towards the 38.2% and 23.6% Fibonacci retracement levels at 1,265 and 1,277 respectively. In the medium-term picture, although gold is looking more neutral, it has so far held on to its run of higher highs and higher lows, therefore maintaining its overall bullish outlook. That's it from me. Thank you very much for watching and have a great day.